Happy Lunar New Year, everyone. I'm Matty Loans. Welcome to Borrow by Build. Back for the first time with more rate cut theater. So, yesterday was a pretty big day. First FOMC announcement in the year and first day of the wood snake. Is deflation in the air? We know that the Fed pushed the pause button on rates for now, but what does the latest Fed speak mean for your mortgage in 2025? And did you catch Jerome Powell's hint regarding inflation and housing? Routinely, Chairman Powell opens the meeting with remarks on the dual mandate, the goals of max employment and price stability. In other words, he has to juggle short term policy that supports the labor market while maintaining a moderate pace of inflation, the target rate of 2% per year. So, how's he doing? Many like to criticize the Fed as the fall man, especially when inflation roars like it's done over the past couple of years. And I think there's just too much emphasis on the Fed. There's only so much they can really do. And it's a job you can't win because if you cut too early, inflation remains. And if you cut too late, well, everyone thinks they should have known better. Overall, I think Jerome Powell has done a great job, and he agrees. And over the past 2 years, he states that the labor market conditions have cooled and inflation's moving closer to that 2% long term goal. Despite the progress, the move for the January FOMC was to leave short term rates unchanged. Why? Because the data says so. Which data? Well, GDP is over 2%. Consumers are still spending money. The housing sector appears to have stabilized. I'm not sure if I agree with that last one, but people still have jobs. And over the last 3 months, the job gains averaged about 170,000 per month, which is still very good. Moreover, the unemployment rate that was once rising seems to be in check. Not too long ago, all the rage was the Somme rule. And it's interesting to hear him comment on the labor market that it's no longer a source of inflationary pressures. So, is all this good news bad news for anybody shopping for homes and loans in year of the snake? Not necessarily, and here's why. Yes, inflation via CPI and PCE remains elevated at 2.6 and 8 respectively. It doesn't appear they've advanced the ball on inflation. However, the Fed suggests that the move to lower rates by the 100 basis points to date was the right move based on the progress they've made while maintaining a strong labor market. Are further rate cuts coming? Yes, they are, as they continue on this path of a soft landing. Mortgage rates are not doomed. Those who think inflation and higher interest rates have been ratcheted up to this new normal fail to account for Herb Stein's law about trends. He famously wrote, "Things that can't go on forever don't." And the thumbnail for this video is a reference to the Billy Crystal Danny DeVito movie from the late 80s, Throw Mama from the Train. I substituted Powell for Mama as if the Trump train is going to have to force his hand. He really won't because soon enough we'll all learn we're playing on the same team. Trump wants to see lower rates, yes, and Powell knows that lower rates are coming. We just don't have to be worried about the pace of cuts because it will change, so don't feel snakebit. The best part, you will not have to wait on the Fed to know we're there. Powell mentioned several times in the presser, we will know when we get there. They're going to remain data dependent. That's obvious. And while the Fed declares there isn't any preset course, Powell knows the policy is still restrictive and effective at driving inflation down. Mortgages are inflation sensitive instruments, and as inflation falls, so will interest rates. It's a lose lose for the market and ultimately a win win for the consumer in this consumer driven economy. Lower rates are en route. It's going to take just a couple of things, either or, a softer labor market or lower long term inflation. This shouldn't be controversial, but that's not what the media is after. Chair Powell outlined the path, and it seems it's pretty simple to me. But the first question from Steve Leisman reminds Donald Trump said in Davos that rates need to come down. The media is trying to create friction, but when you look at Donald Trump and Jerome Powell, they're really on the same page. Where they differ is how long it'll take for rates to fall. And Powell didn't think it was appropriate to involve the Fed in politics because when you fight with a skunk, you end up smelling like. Chair Powell was then asked if short term policy was still meaningfully restrictive, and Powell answers yes, in the context that short term rates are having an impact on the economy still. He goes on to mention how the higher rate effect has an impact on interest sensitive spending in areas like housing. And there's no question it's reduced the sale and purchase of homes in the country. volumes down to the lowest levels we've seen since 1995. And the current environment's hurting many of the banks. Recently, Ally and Washington Federal have exited the mortgage business. Then one of the reporters remarked that the new rhetoric removed the phrase, if the economy develops as we anticipate, dot, dot, dot. And if that was due to the X factor of the new administration. Powell then states that this is business as usual and occurs with every transition. There's going to be changes in the regulatory and fiscal policy, which they're going to use as a placeholder, but it's really short term in the long term play. It's not the Trump agenda that's going to manipulate short term policy, whether that's through reduced energy cost or inversely with tariffs. Rates will come down as inflation abates. For now, the pause for the January meeting is practical because the economy's doing well enough. But if and when they see weakening in the labor market, they're going to make adjustments. Some would respond that the labor market's weakening already. We've seen unemployment rise, the job openings tighten up, although there's still more jobs available than there were in 2019. Just not as many as there was previously. And since September, when the Fed started the cut cycle by the 50 basis points, he mentioned that part of the reason behind it was that the labor market's no longer overheated. Jolts are not a good affinity for the Fed's next move, and Powell says you need to look at 12-month inflation because that takes out the seasonality. Powell's confident that inflation's improving with the exception of one place, housing services. He suggests that this is the last domino to fall, and housing, as the owner equivalent rent, is where the gap remains. Therefore, forecast of the number of rate cuts in 2025 by number and volume isn't going to change the trajectory of short-term policy. At 4.3%, the consensus is still that they're well above the long-term run on inflation. The policy's working. It's having an effect on spending, the consumer, and the job market. When questioned, what does a neutral rate environment look like? Powell reminds everyone that we'll know when we get there. This isn't it. Regardless, the current policy is still restrictive and will continue to hurt mortgage and housing most certainly. The recent spike in mortgage rates back up over 7% appear to be working against housing, adding to the lock-in effect and ruining the affordability improvement we saw in the fall. True, the Fed has reduced rates, and why mortgage rates are higher is in response to a market premium. It's not due to long-term expectations on inflation or policy. Remember, the Fed controls short-term rates. Mortgages work on a different wavelength. And yes, it does impact asset prices. Yes, it does impact the cost of borrowing. But the two, mortgage rates and short-term policy, really have nothing to do with one another. So, what does Year of the Snake present for 2025 to home buyers and mortgage holders? The potential for a whole lot of change. All this conflict between the Fed and the Trump train, it's overblown. Let's face it, Donald Trump wants to see lower rates. The Fed knows that the current policy is still restrictive, and the consumer, they're depending on it. We're going to get back to a regular housing market during this term. Best path forward is lower rates because lower asset prices, let's face it, they're not going to help anyone. Looking back at Trump's first term, here are mortgage rates when he entered the Oval Office and when he left. January 20th of 17, 4.25. When it ended, January 20th of 2021, 2.85. Rates moved down by 1.4% during the term to a new all-time low, but rates were not on a steady decline. There was a high of 5.05% November of 2018, with a low point during the pandemic, 2.76 during January 2021. The second term just started January 20th, 2025, where rates were at 7.08%. His term officially ends 20 January of 2029. Where do I think they're going? I think we've seen the high water mark at 7.08%. I don't think we go any higher. I think it's very possible rates go down to the low fives in the next 12 months as the policy helps aid deflation, dare I say deflation. 2029, it's a long ways away now. But that'll be Year of the Rooster. And my call for rates to bottom out during Trump's term, 1.875. Yes, less than the 2% by a mile in setting a new all-time low. We'll see how well this ages. And I'll see you next time on Borrow by Bill. Thanks for watching.